Hi, everyone. We're going to go ahead and get started. So thank you for joining us today, and welcome to today's installment of Loan Repayment 101 on repayment strategies for health profession students. My name is Lindsay Burcham, and I manage the Financial Wellness at Penn program. Today, I'm going to serve as a moderator throughout the workshop. So I want to let you know ahead of time that we're planning to pause periodically during the presentation to answer questions submitted by the audience. You can direct your questions to me specifically through the chat function, and I'll direct them to Paul when we pause. Now, before I introduce our guest, I want to share a few disclaimers. So as was just mentioned in the chat, we are going to record today's session and the video will be hosted on our website later. So if you have to dip out at any time to go to class or something, you can always review this later, but we recommend you stick around so that you can get your questions answered if you have them. If you don't want to be featured in the video, I'd recommend that you leave your camera and mic muted, and we'll share this video after the presentation. Additionally, I want to clarify that while today's session is intended for graduate students and health professions programs, we do welcome undergraduate students in the audience and hope that today's workshop can answer some of your questions about student loans as well. So today, I'm pleased to introduce our guest. Today's workshop will be led by Paul Gerard, founder and president of PG Presents LLC, an independent student loan consulting company. Mr. Gerard is a well-renowned and respected student loan expert, especially in the graduate and health professions communities. We're very excited to have him with us today to share his student loan expertise with you all. Thanks for joining us, Paul, and I'll hand it over to you now.
Thanks very much, Lindsay. Hi, everybody. It's a great pleasure to have you with us today. We had a huge enrollment or registration for this, so I'm hoping we're going to get some more folks here. And I want to quickly echo something Lindsay said. Although this is targeted toward grad and professional students in the health professions, certainly those of you who are in the undergrad programs, for example, the BSN program, you may be thinking about additional work for a family nurse practitioner degree, or I think there's an accelerated program you can also get in. So if you're thinking about additional work in grad school, we're just delighted to have you, and we certainly hope that this is going to help you. This is actually the second, I think, Lindsay, in the series that we're doing. I'm going to show you some upcoming workshops that we've got scheduled for you, but we've got so much to cover today. I don't want to go too fast. We are going to stop for questions, but I want to start out today, Lindsay, by reminding everybody that there's a lot of information we've already recorded in individual modules, stuff on public service loan forgiveness, refinancing, federal consolidation. We've already had some questions on that I'm going to get to later. So those are already on the Financial Wellness at Penn website. So if you haven't looked at those, at least go take a look and see what kind of menu options you've got there. And again, they're short and you can kind of listen to the one you want to. We would encourage you to contact the Penn Student Financial Services Office. I'm going to reference them throughout. We've got some of the folks from that office on this call, obviously. We try and post a lot of free stuff on our website, including stuff on public service loan forgiveness, the most up-to-date information possible. Lindsay, as you know, I'm going to reference that a little bit later. And you can always work with your loan servicer. They're the ones who've actually got your student loans, and that's who you're going to be working with in repayment. So a lot more help for you guys. You'll get, as I understand, Lindsay, emails about these upcoming workshops. I think they may actually come through your school or your programs. But if you're curious, we're going to do one specifically on married borrowers and repayment. I'm going to briefly touch on that today, but we're going to do a full workshop on that on the 14th. In November, we've got one on repayment calculators. There's some great calculators out there, but guys, you got to know how to use them, and you got to know what kind of assumptions these things make, or you'll get some really crazy numbers. And then in December, we're going to do one specifically on federal consolidation and refinancing. But not to worry, we are going to talk a little bit about federal consolidation today, because that's one of the questions we've got. So a lot of ways to help you guys and a lot of stuff coming up to help you. Okay, as Lindsay knows, I have been doing this for, my gosh, almost 40 years. That doesn't necessarily make me an expert, but most of that time has been spent with health profession students and grad students. And I started thinking about how you guys are inherently kind of sort of different than the undergraduate population. And that's certainly not an offense to the undergrads. These are things that you probably know, but just a reminder, depending on the degree program you're in, whether it's a master's program or dentistry or going for the MD program at Perelman, or a public health degree. Depending on the degree program, you may have higher limits for your direct unsubsidized loan, as I think many of you know. But one thing I want you to always remember, while we're not trying to encourage excessive borrowing, whether you're in a master's program in nursing or a doctoral program in nursing or the dental school going for the, I hope I don't get this backwards, it's either the DDS or DMD, sorry Lindsay, I think I've messed that one up, or the MD degree at Perelman or the Doctor of Veterinary Medicine. Remember, regardless of your degree program, if you're in grad school, you can always borrow a grad plus up to the full cost of attendance, regardless of how much you can borrow in the direct unstub. And that's one reason you guys are always able to fund your graduate education in the health sciences. Also, depending on the degree program, there's some special loans that are just for your discipline. You may not know this. That's one of the things we're going to get into a little bit later today. And if you've got some questions after we go through this workshop on those loan programs just for your discipline, please contact the Student Financial Services grad team and they can help. And certainly, I'm very prejudiced about this. I think you guys have got very unique counseling needs, in part because many of you either have a required residency program or you have the option to do additional postdoc work. And we've got a question already pending about that I'm going to get to. A little bit more in terms of why I think you guys are a bit unique. I do think you've got potential higher salaries and maybe a better return on investment than some other folks. But you also have higher opportunity cost, and that just simply means that while you're in school taking on debt, you could be working. I don't know how much you could be making, but that's lost income. So you've got higher opportunity costs to go with the tuition and stuff you're paying for grad school. As I've already mentioned, some of you have got a mandatory residency program. That certainly would be the folks at Perelman, a minimum residency of 3 years. Others of you have optional additional training. If you're graduating from dentistry, you can do the 1-year GPR. You can do advanced dental education work in a academic setting. You can do, if you're a veterinarian, you're not required to do an internship or residency, but you can. So you've got additional training time, if you will, that sometimes puts you more into debt than you were, and also, though, potentially gives you some higher income. And I do want to pay special attention to this last bullet. As Lindsay knows, we're not pushing public service loan forgiveness on anybody, but we want to be sure you know exactly how it works. We had a workshop on it last week. I hope some of you were at that workshop. We're going to review some of that stuff again. But Lindsay, as you and I've talked before, I do think there's probably a higher likelihood that if you're working in the health sciences or you have a degree in the health sciences, you could end up in the nonprofit public sector. Thus, you ought to at least be considering public service loan forgiveness to help you out. Now, real quick, because I want to jump really into some of the particulars, a reminder that all of this stuff is not going to make any sense unless you know what your student loan portfolio looks like. What have you borrowed? We're going to look at that in a moment. Who your loan servicer is, who are you going to be working with repayment, and when those loans come due. And then you've got to obviously decide, do you want to be aggressive and go bad at it? You know what to pay these loans off to reduce the interest cost on some of these things? Or do you need to be cautious? Or are you possibly going to hold back and make minimum payments because you're trying to maximize public service loan forgiveness? You got to decide how you want to do that. And then you need to select a repayment plan to meet those objectives. Okay. Now, right out of the gate, the older I get, the crankier I get. And I want to be sure you guys are using the correct terminology for some of these programs. And so let's talk semantics for a minute. Guys, this is hugely important. Lindsay, I looked at some websites, and with all due respect, some of the websites of these programs still have incorrect terminology here. So guys, be sure you understand the difference between a forgiveness program and what we commonly call an LRAP, a loan repayment assistance program. Now, a forgiveness program is really pretty simple. It's where the lender actually will forgive the debt. They'll waive the remaining balance or forgive the debt if you meet certain eligibility requirements and under certain circumstances. The easy example for that is the public service loan forgiveness program. There's also, by the way, a teacher loan forgiveness program where the amount is prorated that they forgive. But that's where you owe the lender, in this case, the Department of Ed. You owe them money. They're the ones who loaned it to you. but they'll forgive it if you meet certain requirements. That is different than a loan repayment assistance program that we call LRAPs. The loan repayment assistance programs, this is where a third party, and it's going to be your employer, actually says, look, we want you bad enough, or in exchange for a commitment to do service, perhaps in an underprivileged area, or to come work at our hospital or our clinic for a couple of years or wherever, we will give you money. We're not forgiving anything. We didn't make you the loans, but we will give you money, financial assistance, to help you pay the debt down in exchange, again, for a service commitment, or you saying, I promise to work there for a couple of 3 years, et cetera. That's what a loan repayment assistance program is. And examples of those include the National Health Service Corps, the Indian Health Service, the Armed Forces, the Nurse Corps Loan Repayment Program. And sometimes states will say, hey, we want you bad enough as a primary care physician or as a family nurse practitioner. We want you bad enough that we will pay you not only your salary, but we'll give you $10,000, $15,000, $20,000 a year on your student loans. So be sure you understand the difference between forgiveness and loan repayment assistance programs. Okay, let's talk about public service. We talked about this last week, but I want to be sure we get this out on the table, because a lot of the questions that we get and a lot of what we're going to cover today with regard to y'all's repayment strategies may hinge on whether or not you're interested in public service. Lindsay, I hope I've got the number right. I think this is module number 8 on the Financial Wellness at Penn website. So please feel free to go take a look at that. Now, a quick reminder, this program it's really not difficult to understand. This program was passed into law in 2007, and it was designed to get borrowers of any degree program, any specialty. It has nothing to do with nursing, nothing to do with dentistry, veterinary medicine, engineering, law, etc. It doesn't matter what your degree program is. The government wants to get you guys to go work in the nonprofit public sector, kind of under the assumption that you're not going to make as much money if you do. But if you meet certain criteria, after 10 years of working in the nonprofit sector and making 10 years worth of payments, the government doesn't care what you owe. They'll just forgive it and you don't have to pay taxes on it. It's the steal of the century. That's what the Public Service Loan Forgiveness Program is. Now, unlike the loan repayment assistance programs, if you do an LRAP, you have to sign some kind of commitment with your employer. I promise, in the case of National Health Service Corps, you have to sign a commitment that you will go work in a health profession manpower shortage area for the period of time that they're going to give you money. That's a commitment. If a state says, we want you to be our family nurse practitioner, you've got to sign a contract that, okay, I'll do that for 2 years in exchange for X amount of dollars. With public service loan forgiveness, guys, this is one of the unbelievable things about this program. You don't sign a commitment for public service loan forgiveness. You just start making payments on your loans while you're working full-time for a nonprofit. We're going to look at that on the next slide. I would encourage you to take a look at our statement on the Public Service Loan Forgiveness Program. Lindsay, I'm not going to dive too far into the weeds on this because we don't have enough time with everything else I want to cover. But guys, if you're curious about, we talked about this last week, if you're concerned about the high percentage of denials you may have heard about, take a look at our statement. We think you'll get some comfort level and not to be too concerned about that. We also address on our website in the statement, which is easy to access, it's right on the homepage, we address the proposed changes in the program. So that's what PSLF is, but guys, look at the qualifications. Now, again, maybe it's because I do this all the time, I don't think this is a terribly difficult program to qualify for. You see 3 eligibility requirements. These 3 things, guys, have to happen at the same time in order for you to qualify. So whether you're in the School of Dentistry or Medicine or a nursing program or veterinary medicine or public health, whatever your program is, look at these 3 criteria. Number 1, you got to make 10 years worth of payments. That's 120 payments. You can't shorten the time period. You make 120 scheduled payments with an eligible plan. And guys, an eligible plan is an income plan like pay as you earn or revised pay-as-you-earn. We are going to look at those plans again. We looked at them in detail last week. I'm going to give you a brief review of that coming up here in just a little bit later in the workshop. So you're going to make 10 years worth of payments. Look at number 2, real important. You have to be making your payments on loans the government made, direct loans. Now, very shortly, as Lindsay knows, she's seen all these slides, we're going to talk about the Title VII loans that you guys as health profession students are eligible for, and Title VII loans do not qualify for public service loan forgiveness. One of the main things we're going to look at today is, should you consider consolidating or switching Title VII loans into the direct loan program? Guys, we're getting to that. What I want you to take away here is the only loans that qualify for public service loan forgiveness are loans the government made. So it's 10 years worth of payments with an income plan on direct loans. Number 3, while you're working full-time for an eligible employer, and an eligible employer is a public sector nonprofit. I've got down there some examples: 501c3, the government. I know we've got, at least I think we had some public health folks register for this program. Something like 65% of public health graduates go into the government. So you guys are primo candidates for this program. .edu, many institutions qualify, and .org, nonprofits. So that's how you qualify for the public service loan forgiveness program. Now, we had a question come in. I tend to shoot straight from the hip here, which is, I hope, okay. I was going to save this slide till the end because this gets really into the weeds, but somebody sent a question in about this. I think Nicole Gordon's on the call from SFS, and I think maybe the question came to you here. So I want to talk real quickly, and then we'll move on, about public service loan forgiveness and postdoc work. In other words, once you're done with your degree program, whether it's veterinarian, whether it's nursing, whether it's dentistry, whether it's medicine, can you start public service loan forgiveness? Okay, first of all, remember the criteria. You got to be making regularly scheduled payments with an income plan on direct loans while you're working nonprofit for a nonprofit entity. Okay, many teaching hospitals, in fact, probably most teaching hospitals, whether it's medicine or dentistry or veterinary medicine, are nonprofits. There's a way to confirm that, but most of them are. Okay, look at number 3. This is where it gets a little complicated. And guys, we're going to stop for questions later. So let me just see if I can walk through this without muddying the waters here. You got to be in active repayment status for payments on a loan to qualify. You can't make a voluntary payment during your 6-month grace period and be working for a nonprofit and have that qualify. You got to wait till your grace period's up, enter repayment, and then those payments would qualify. So you've got to be in active repayment status where you've applied for and been approved for an income plan before the PSLF clock will work. Okay, so Lindsay, what I tried to do, and I hope this will answer the question that came in, I want us to look at 2 scenarios. If you are a dental school graduate and you go right into a 1-year GPR residency where you're working at a teaching hospital, you're getting a stipend, and you are not taking additional coursework, or you're the typical MD graduate where you have to do a 3-year residency program and you're not taking more classes. You're not, for example, also doing a public health degree. So you're just kind of a typical resident. Then it's frankly very easy to start qualifying for public service loan forgiveness because you're really not doing postdoc work. You're going to be starting to make payments with an income plan while you're in your training. You're working for a nonprofit teaching hospital. You wait till your grace period's up, you enter repayment, sort of piece of cake. That's why so many residents are interested in public service. It's easy to start the clock there. But look at the second deal here, and this is where it gets a little complicated, and my apologies here for it being complicated. If you're doing an internship residency program, but you are also enrolled in school, and the most common example I've seen, I think the question came from a veterinarian, but the scenario we see most often is somebody who is graduating from medical school and they're doing a public health degree program. So while they're in their residency, they are actually enrolled in school working on a public health degree. Guys, here's where it's going to get a little complicated. The eligibility is in large part going to depend on your enrollment status. Now listen carefully. If you are enrolled in a program less than half time, then it is not going to be a problem. Once your grace period's up, you can start making payments and start qualifying for public service loan forgiveness. But if you are enrolled at least half time, you've got to use up your entire grace period before you could ever start making payments that qualify for public service loan forgiveness. And stay with me on this. If you're enrolled at least half time, you're going to have to wait until after your grace period has expired, because you can't enter active repayment status until after the grace period has expired, and you can't waive your grace period. So here's what is likely going to happen. I'm willing to bet that if you go right into a residency program, you're going to start your enrollment in your public health program. That's what I'm using as an example, pretty soon after you graduate. Well, in that case, guess what? You're not even using your grace period. You're going to be in an in-school deferment status that you can't get out of. So I hope that makes sense. You can't start the clock unless you've used up the grace period on your loans. And there's only one way around that, guys, and that's going to be to consolidate, which we're going to talk about later. Lindsay, I know we're going to get more questions on that. And Nicole, and to the folks from SFS, I'm happy to go back through that with you for the borrower or borrowers who have that question. So Lindsay, let me move on. In fact, I think this is the slide I actually had in there, sorry. Look at the second entry there, the internship residency enrolled in school. Look at the highlighted red bullet here. If you're half-time or more, you can't start PSLF eligibility unless you either consolidate before the enrollment starts, and the reason for that is consolidation loans don't have grace periods, or your enrollment starts after the 6-month grace period, and that's what I just mentioned earlier. So happy to talk about that more, Lindsay, later if we get more questions, but I do want to move on. I wanted to at least address the question that came in from the borrower. Now, a few more things about LRAPs. Once again, as I mentioned, this is where an employer gives you financial assistance directly to the borrower to pay your student loans. Sometimes the payments are sent to the borrower, and sometimes they're actually sent directly to the loan servicer. I want you to look at bullet number 2. These are not mutually exclusive for somebody who's interested in working in the public service loan forgiveness program. For example, if you're a dental school graduate, you've got a boatload of debt, and you are interested in working in the public sector, the nonprofit public sector, and you're interested in the public service loan forgiveness program, but you're also interested in the National Health Service Corps. If you're approved for the National Health Service Corps, I assure you that qualifies as an eligible employer for public service loan forgiveness, but they're going to give you some money to pay down on your loans. And all that means is you're just going to have less to forgive. You're kind of double dipping, but you're not mutually exclusive. You can do public service loan forgiveness and an LRAP as long as your employer is a for-profit. I want you to look at the last 2 bullets though. This is hugely important, guys, if you're considering an LRAP. Be sure to ask, if you're going to be given financial assistance through an LRAP, be sure to ask about the tax implications. Here's why. With the National Health Service Corps, that's $30,000 a year that does not have to be claimed as taxable income. But if you, for example, go to work at a state says, look, we really want you to be our family nurse practitioner or our veterinarian in a shelter or something, and they say, I'm going to give you $20,000 a year for 2 years. You need to find out, do you need to claim that as taxable income or not? If it's taxable income, it may still be worth your while doing it, but you're not going to have $20,000. You're probably going to have more like $13,000 or $14,000. So always ask, how is the financial assistance treated as taxable income? But guys, Lindsay, I don't know if you and I talked about this before, but look at this last bullet. There have been more complications with this than there need to be for borrowers who are trying to qualify for public service loan forgiveness and make lump sum payments on their loans, especially with LRAPs. Look at this carefully. Remember what we said about the eligibility for public service loan forgiveness. It's 120 regularly scheduled payments to qualify. If you get financial assistance, let's say you get a $10,000 bonus for American estate. Let's just use that as an example, $10,000. Okay, there are two ways that $10,000 can be applied on your loans. It can be a lump sum payment on your most expensive loan. For many of you, that would be Grad Plus. Or it can be treated as paid ahead status. Now, what in the world do we mean by that? You're probably way ahead of me. Humor me for a moment since I'm not good with numbers. Let's suppose that your monthly payment with an income plan is $200 a month. And let's suppose that you get $10,000 from your state and they send that directly to the loan servicer, and the loan servicer applies that as paid ahead status. What that means is for the next 5 months, 5 times 200, you don't need to make a payment. Well, that's accurate for paid ahead status. But if you're trying to qualify for the public service loan forgiveness program, those 5 months do not count because they were not treated as regularly scheduled payments. So listen carefully. If you're interested in public service loan forgiveness and you get extra money through a LRAP, or frankly, Lindsay, they just get extra money, I don't know, graduation or something, or somebody, all of a sudden you get a lump sum payment you want to put on your loans, have the servicer treat it as a lump sum payment on your most expensive loan. Do not mess up your regularly scheduled payments with an income plan. So hugely important if you're doing an LRAP in your instant public service loan forgiveness. Do not let the servicer treat it as paid ahead status, or you're going to mess up your account for your public service loan forgiveness. Okay, and don't forget, we are going to be stopping for questions here. I just thought I'd give you some examples of LRAP. I've already mentioned some of these. Lindsay, I was going to go through some of the particulars. I started looking at the website, and guys, y'all are smart. You can do this on your own. Just check the websites for the different information on eligibility, what disciplines qualify, and what the application dates are. Some of these programs, as you may know, are extremely competitive, and they have early deadlines. So those are just some examples of LRAPs. Okay, let me stop for a minute, Lindsay, and let's see if we've got any kind of questions coming in.
Thanks, Paul. So far I've only received one question. So while we're going through this, if you have questions on what was just covered, feel free to send them to me through the chat and we'll get them covered before we move on. So Paul, the first question I got was from a student who asked, is it worth putting money into a 529 plan, even if it's a small amount, to use for expenses next year or to pay off the loans?
Great question. I would respectfully say, kind of beyond my pay grade, we try to be right up front in that we like to think we know all the ins and outs of student loans and repayment, but we're not financial planners. So I would encourage you to learn as much as you can about how the loans and borrowing work, but that question would be better suited, I think, for a financial professional like a CFP, certified financial planner, or a chartered financial consultant. So thank you for the question, but that, Lindsay, that's just out of my area of expertise.
Yeah, I think that sounds good. Let me see, one question just came through.
Okay.
So this student is wondering if you know about the $5,500 that employers can offer as a benefit to pay back loans.
I don't know where that amount came from, but if it's an employer who's saying, hey, we'll pay you, do they say, is it $5,500 like one time, or is like every year, or do we know?
I'm going to give the student a moment to
type. Me though, whoever asked that question, once again, if they're going to give you extra money to pay on your student loans, I go back to what I said here earlier. If you're trying to qualify for public service loan forgiveness, then you want them to treat that as a lump sum payment on your most expensive loan. Look for the loan that's got the highest interest rate on it. If you don't want it to be paid ahead status. Now, if you're getting extra money and you're not trying to qualify for public service loan forgiveness, you might like the fact that you're not going to have payments for a while. You might want to treat it as paid ahead status. I just want to be sure you guys know, if you make a lump sum payment on your loans and you're trying to qualify for public service loan forgiveness, do not let them treat it as paid ahead status. Okay. So Lindsay, I looked at the clock. Oh my gosh, it's already 12:30. So let's keep going if we can.
Sounds good. Thanks, Paul.
Okay, so guys, your student loan portfolio, we covered part of this last week. There are three general categories of loans: federal direct loans, where the government's the lender; what we call campus-based, where the school's the lender, in this case, obviously Penn; and the Title VII loans we're going to look at here in a moment. They're a perfect example of campus-based loans. And then private loans, where the bank is the lender. And respectfully, again, because Grad Plus has no annual limit other than the cost of attendance minus all other aid, it's not that we're anti-private loans, you just don't need them when you're in grad school. Okay, look carefully here. The federal loans are called Title IV. ED just stands for Department of Education. Now, the two loans you should be familiar with in grad school are direct unsubsidized, again, different amounts you can borrow depending on your degree program, and Direct Plus that we call Grad Plus. If you're not sure what you borrowed, the studentaid.gov database, you'll log in and look for a dashboard. It's got them all listed there. But look at the listing of what are called Title VII loans. These are they're federal, but they're through the Department of Health and Human Services, or HRSA. And there are four different types to look at that we're going to look at: nursing student loans, health profession student loans, loans for disadvantaged students, and primary care loans. There's no national database of these things. So let's take a look at these real quickly individually. And I meant to say this earlier, or maybe I did. If you see one of these loans and you're interested in it, and you're in a degree program that would qualify, and you either, you didn't know you could apply for them, talk to the Student Financial Services Office, the grad team, about your eligibility. It may be that you were already considered and weren't eligible, but you should at least kind of find out if these are loans you should be interested in. Nursing student loan, undergrad and grad nursing students. Guys, look at this: 5% fixed rate, 9-month grace period, repayment of 10 years. And look at this: interest-free during school and grace. So if you borrowed a total of $20,000 while you're in school, it's going to be $20,000 when you enter repayment. How nice is that? But these loans are not eligible for income plans or public service loan forgiveness, as you're going to see here in a moment. But that's a nursing student loan. 5%, not a bad deal. Health profession student loans, we call them HPSLs. Dental and veterinary students, 5% fixed rate. You've seen that before. 12-month grace period, 10-year repayment term. Now look at the third indention: interest-free during school grace and deferment. So if you qualify and receive a health profession student loan, and you borrow, $30,000 over the course of your program, it's going to be $30,000 when you enter repayment, which is not the case with Grad Plus and Direct Unsub. But look, these loans are Title VII. They're not eligible for pay and repay. They're not eligible for public service loan forgiveness unless you consolidate them, which I assure you we're going to get to. Two more. These are called LDS loans, loans for disadvantaged students. Once again, dental and veterinary students, 5% fixed rate. You'll see that all these Title VII loans have 5% rate, 12-month grace period, 10-year term. That's very familiar. Same thing, interest-free during school grace and deferment. Whatever you borrow, the interest is not starting until you actually enter repayment. But once again, it's a Title VII loan. It's not eligible for income plans. It's not eligible for public service loan forgiveness. And then primary care loans. These are only for medical students, MD or osteopathic. I know Penn doesn't have an osteopathic school, but your osteopathic colleagues can get these. 5% fixed rate, 12-month grace period, 10-year term, interest-free, etc. But you do have to sign a commitment into primary care, and these loans are not eligible for income plans or public service loan forgiveness, and they cannot be consolidated. So Lindsay, I think this is a slide you kind of sort of liked. I tried to give you guys a visual so that you could see right up front, depending on what kind of loans you have, how you repay them. Are the time plans available? Yes, on every single loan, always. Income plans. Only kind of loans you can use an income plan are direct loans. Public service loan forgiveness, it's only going to be on direct loans. Can you consolidate your Title VII loans, which we're going to look at? The answer to that is yes, except for those of you from Perelman who might get a primary care loan. You cannot consolidate a primary care loan because of the commitment into primary care. And all these things can be refinanced with a private lender. By the way, a little plug that we are going to do again, a special workshop on consolidation and refinancing. So hopefully this is a slide that you can, at least from a visual standpoint, see what kind of plans are available on the different loans I have, the direct loans and the Title VII loans. Okay, so as I recall, the title of this workshop was Strategies. We'll take a look here. Two ways to look at this, guys. If you have Title IV and Title VII loans, there are two ways you can do this. You can keep them separate, or you can consolidate them, again, with the exception of primary care loans. Now, who would keep, I think this is, Lindsay, one of the questions that came in ahead of time of this workshop, so I'm going to try to answer it here. Who would consolidate and who wouldn't? Now, there are always exceptions, but in general, somebody who is just not interested in the public service loan forgiveness program, or who has a really low balance in a Title VII loan, these borrowers would tend to keep them separate and not consolidate. For example, if you've got, let's say you've got a $4,000 nursing student loan from college, and that's all you've got in Title VII. Okay, the minimum payment on that is going to be, I think it's $50 a month. Well, that, with all due respect, that's not a huge balance. If you're not trying to qualify for public service loan forgiveness, or your balance is low, you might just say, forget it, I'll just pay that thing separately, I can afford it. But who might consolidate Title VII into the direct consolidation loan program? Look carefully. It might be someone who's interested in public service who has a high balance in their Title VII loans. And the theory there is really simple, is if you're going to qualify for public service loan forgiveness, it's pretty rare you're going to meet anybody who wants to qualify for public service loan forgiveness on just some of their loans. For example, now it wasn't at Penn, but I worked with a medical student who had $100,000, Lindsay, in the LDS loans. Great loan, but that loan would never qualify for public service loan forgiveness. And this particular medical school graduate was adamant they were going to go work in the nonprofit sector. And so they were a perfect candidate to consolidate and switch the balance of their Title VII LDS loan into the direct consolidation loan program so they'd qualify for public service loan forgiveness on everything. Now, somebody else who might consolidate Title VII into direct consolidation loan program is somebody who's not necessarily interested in public service loan forgiveness, but just doesn't want an additional payment of their Title VII loans on top of the payment they're making with direct loans. Excuse me, and I'm going to show you an example of that right here, coming up here in just a moment. Okay, before I show you that though, just a reminder of what federal consolidation is. I said this over and over again last week, and I hope I didn't insult anybody's intelligence. Guys, just keep it as simple as possible. All federal consolidation is literally trading debt for debt. It's paying off multiple federal, I'm sorry, not private loans. Private should not be in there. It's paying off multiple federal loans with one new federal loan. Sorry, once again, private should not be in there. That's a typo, my apologies. The only option for consolidating, that should say federal Title VII. The only option, guys, for doing federal consolidation is with the feds in the direct consolidation loan program. Now, what are the advantages of direct consolidation? Well, it's one loan. If you consolidate everything, all the loans you consolidate are paid to zero, and you've now got one loan, one servicer, and one payment. But I want you to look at that double asterisk. Most of you who've got direct loans, you've already got one loan servicer. We talked about that last week. You may be coming out, excuse me, of veterinary school with 4 direct unsub and 4 grad plus, 8 different loans. But I'm willing to bet they're with the same servicer. So you already have the convenience of one payment. But if you've got multiple loans, multiple servicers, direct consolidation will make that easier for you with one loan servicer, one payment. But look at the second indention. The advantage of direct consolidation is it converts non-direct loans, Title VII loans, into a direct loan balance. We just talked about that. Now, what's a disadvantage to consolidating? There's a slightly higher rate. This is not really a reason not to consolidate. If you read our cheat sheet on federal consolidation, or Lindsay, if they watch the short module on federal consolidation, the rate is calculated as a weighted rate of all the loans you're consolidating. And then guys, it's raised up just 1/8 of a point. That's only 0.125% higher. And then it sticks for the life of the loan. But technically that's a disadvantage. But I want you to look at the last indention there. If you've got multiple loans with multiple interest rates, which you will when you graduate, and you overpay, as you heard me say last week, you can overpay on the most expensive loan. When you consolidate, you can still overpay with no penalty. You just don't quite get the best bang for your buck because you can't target the additional payment on the most expensive loan. Okay, let me stop and see if we've got questions. And then Lindsay, I want to show some repayment examples here.
Great, thanks, Paul. So far, no new questions for you have come in. I guess I will share one question that's come in more related to SFS at Penn has been, if I have overborrowed and I need to return part of my loan, can I? And the answer is yes, you need to email graduateaid@pobox.upenn.edu.
Great. And we're going to show that address, Lindsay, I think, again at the end.
Perfect. Thanks, Paul. That's all I have right now. So if we want to move on and we'll catch all the questions at the end.
All right. Well, I've either completely confused everybody or maybe we're doing okay here. Okay. I want to get through this quickly. We covered some of this last week, and I'm trying to be careful about the time here because I do want to show you some repayment numbers. Guys, once again, when your loans come due, just find a plan where the required minimum payment's comfortable and manageable in your budget. And then you decide, do I want to be aggressive and overpay on the highest rate loan, which I talked about? Or if I'm trying to qualify for the Public Service Loan Forgiveness Program, that's the last thing you'd want to do. Why would you overpay on your loans if the government's going to pick up the tab tax-free in 10 years? But the first thing out of the gate is just run the numbers and find a plan you're comfortable with. And we always encourage you to look at time plans first. Remember that your debt is not going to come down until you pay more than the outstanding interest that's due. And guys, if you've got a Title VII loan, look at that last bullet. Now just humor me for a moment here. A direct unsub has a 6-month grace period. Okay, so it's going to come due 6 months after you graduate. If you got a nursing student loan, that's got a 9-month grace period. It's going to come due 3 months later. So when you're doing your budget, once you start working in your job, don't forget, as you're doing your budget, don't forget to factor in the fact that, okay, how much am I going to have available for the entire student loan payment on both of my loans, the ones that come due 6 months out and the ones that come due 3 months later. So start budgeting for when all the loans are due. And a reminder, the time-driven plans, these are pretty simple. The loan servicer just takes your balance and they throw it out over a 10 or 25-year term. It's the same payment each month. And when you do a time plan, guys, your principal starts to come down immediately. That's one of the big advantages of these plans. Now, into the term, the debt's gone. You don't have anything to forgive. That's one of the reasons these plans are popular. Look at the 4th bullet. Another reason these plans are popular is a monthly payment. It just doesn't have a thing to do with what you make, what your marital status is, how you file your taxes, your family size. The servicer's just taking it and spreading it out in even payments over 10 or 25 years. Title VII loans use time-driven plans. We showed you that on an earlier screen. But the income plans are completely different. The income plans are designed for somebody who's got a pretty big gap between your total debt and your income. Coming out of nursing school, $150,000 in debt. Let's say you're making $75,000 a year. I would argue that's a pretty big gap. You're probably going to need an income plan. The bigger the gap, the more likely you need an income plan. Pay and repay, as we said last week, those are the most popular plans. If you hear the term IBR, guys, it's a much, much older plan. Very few borrowers are using IBR these days. The payments with income plans are based on income from a prior year, and they're based on family size, and the payments change every year, as we discussed last week. Once again, if you didn't attend last week, we'd encourage you to watch that. Lindsay, I think you said it's also on the site. But look at that last bullet, Title VII loans. If you've got a nursing student loan, LDS, loan for disadvantaged students, health profession student loan, primary care loan. These loans are not eligible, excuse me, for income plans. Okay, real quickly. The payment calculation is based on income from a prior year, excuse me, tax return. And that's why some of you guys, and hopefully this will be covered with you before you graduate, if you file a tax return your last year of school and you use an income plan, there's a pretty good chance you might be able to get a zero payment the first year when you do an income plan pay or repay, because the servicer is basing it on last year's income from your tax return. They'll use your current income if you're making significantly less than last year, if you've lost your job or your hours have dropped. Okay, now, as we said last week, really, really important if you do pay or repay. If you're using an income plan, guys, one of two things is going to happen on your loans. You're either going to have the debt retired after 10 years worth of payments with public service. If you don't do public service, you're just going to retire the debt before the term is up, or you're maybe going to refinance it with a private lender. Because if you use an income plan and you don't use public service loan forgiveness to retire the debt, and your debt is so high that you can't get it retired by the end of the term, the government will forgive it for you. It's called term forgiveness, but that's considered taxable income. Easy example. Maybe you're using pay as you earn, 20-year term. If you use pay as you earn and you do public service loan forgiveness, you'll never hit year 20. Your debt will be gone in 10 years. If you use pay as you earn and you don't do public service loan forgiveness, you've got 20 years to get rid of that debt, because if you don't, the government will get rid of it for you, but they will tax you on the amount forgiven. And the public service loan forgiveness amount is not considered taxable income. Now, Lindsay, I'm looking at the time here, and since we covered these two things, I want to show you guys, we have a slide on the module on the recording last week where we talk about pay versus repay, and we also have this slide from last week. I was repeating a little bit because we talk about this. We've got this information about who is best suited for pay and who is best suited for repay. Lindsay, I don't want to spend time on these because I want to get to the following here, and then I'm going to stop finally for questions. I want to show you some repayment numbers because it's about 10 till here. I would strongly encourage you to get a good calculator. The student financial services folks, especially in the grad team, can show you ones. There's some that are designed specifically for individual disciplines, but run your own numbers. I want you to look at the assumptions I'm using in the repayment numbers I'm about to show you. I'm using 150,000, and I'm going to use nursing as an example. Now, I have no idea. We have a lot of nurses on the call, I think, which is great. I have no idea what y'all's debt is or is going to be. It could be much lower than 150. For some of you, it could be much higher. But I'm going to use 150,000 and look at the breakup or the breakdown. It's 130,000 in direct loans, unsub and grad plus. And then this particular borrower has 20,000 in nursing student loans, Title VII. And a reminder, the direct loans in a repayment 6 months out, and the nursing student loans in a repayment 9 months out. This borrower is single, family size of 1, no change to marital status. And I know these salaries can vary to our friends who are nurses watching this, but I'm using a $75,000 starting salary. Now I want you to take a look at this. Let me see if I can move this slide. Okay. All right. The 130,000 in direct loans, you've got 3 options I'm showing you. You've got a 10-year plan where the payment, guys, is just over $1,600. You can extend that to 25 years and drop it. Or you can use pay as you earn and the payment drops dramatically. But remember what we said, you got a budget for your full when everything is due. So if you don't consolidate, go back to the strategies we talked about. If you've got Title VII loans, you're either going to keep them separate or you're going to consolidate. If you keep them separate, look at what's going to happen. You owe about $1,600 on a 10-year plan if that's the one you choose. The nursing student loan is on a 10-year plan. That payment's about $212. So in this case, Lindsay, the payment's going to be, excuse me, the payment's going to be about $1,800 a month. Well, what if you go, are you kidding? That's just no way I can do that. Okay, so you go to the next option. And the next option with direct loans, stretch the payments out over 25 years. You might eventually overpay, but you're looking for a monthly payment you can afford. Well, if you do a 25-year plan with your direct loans, that payment drops down to under $1,000 a month. But your nursing student loan is still $212. So you've got to add that to the $991, but now your total payments dropped about $600. It's $1,203. Well, what if you look at that and you go, that is still too much. I can't afford that. Okay, you have no wiggle room on the nursing student loan. It's $212 a month. But what if you used pay as you earn? Pay as you earn is based on your income, not your debt. Look how low that payment would be for the first 12 months. So now, Lindsay, as you know, because you saw this chart, now this borrower using an income plan known as pay as you earn and keeping the loan separate, their monthly payment is down to $678 a month. That's if you don't consolidate. But watch what happens if you do consolidate. If I can get it to the next slide here. There we go. Okay, look what happens if you do consolidate. Notice the nursing student loan is gone. What did we say consolidation is? Consolidation is you pay everything off and replace it with one new loan. So now your direct consolidation loan is $150,000, the 130 plus 20. Okay, look at the standard 10-year payment. Well, of course, it's higher than originally standard 10-year because it's a higher balance, $1,696. Look at the 25-year. It's about $1,000 a month. It's a little higher because, again, you've got a higher balance, 150 compared to 130. But Lindsay, this is what I want everybody to take away. Excuse me. I want you to look at the payment with pay as you earn. Guys, if this borrower consolidated their Title VII loans into the direct consolidation loan program, the nursing student loan doesn't exist. That balance is now part of a direct consolidation loan. And if this borrower uses pay as you earn, look at the payment. It stays at $466. Why is that the case? Because the monthly payments with an income plan are based not on the debt level, they're based on income. So Lindsay, as you know, what we're trying to show here are ways what would happen to a borrower who left their Title VII loans separate, and what would happen to that borrower if he or she were to consolidate their Title VII loans. And guys, this is just using $20,000 in a nursing student loan. So with that, let me see here where cursor is stuck. There we go. So real quickly, your to-do list, track your loans every year. We've talked about that before. There's the reference to the calculators. I see a note has already come in about the repayment calculator workshop. We're actually going to have you guys do this along with us as we go through that calculator workshop later on. We encourage you to be cautious where you get your information because there's a lot of misinformation about repayment out there. And we are going to encourage you to always talk to Student Financial Services. So Lindsay, it's about 4 minutes till. I hope we didn't fly through that too fast, but I did want to stop and see if we had any questions that came in.
Thanks, Paul. I haven't had any new questions come in. I guess we can give it a little bit of time to see if folks want to send them in the next minute or so and we can address them. And then if no one has questions, we can wrap up.
Okay, and happy to answer them. You know, if you've got them, go ahead and send them in right now. But again, if you've got questions about the particulars about loans or financial aid, there's the phone number and also the mailbox for Penn Student Financial Services. And if you've got questions about general money management, you can send them to Financial Wellness at Penn, Financial Wellness at upenn.edu. One thing we do want you to do for us, I think, Lindsay, is this going to go out in an email to them, or did they just go directly to this right now?
It'll come out in an email afterwards. So you can always use the short link right here to access the evaluation, but I will send it to everyone that attended via email after as well.
Great, because we really do, this is, like I said, this is the second of 5 we're going to do. We want to be sure these are meeting your needs. And you know, we think we know what you might need in terms of information, but you know, let us know if we're missing something. If you've got any particular questions, let us know ahead of time. So Lindsay, with that, I say thank you very much. Always fun to do this. I hope it was helpful and appreciate your help, Lindsay. And I'll stop right there and see if we have any more questions come in. If not, you guys stay safe. Thank you very much for joining us.
Great. Yeah, thanks everyone again for joining us today. We hope we were able to answer some of your questions. Oh, and actually it looks like one just came in. So Paul, for public service loan forgiveness, do government jobs count even though they aren't nonprofit? And Paul, I think you're muted if you're trying
There
to
we go.
answer.
Sorry. I'm curious about that question because usually a government job is nonprofit. That's a little surprising to me. Now, what Taylor, I hope it's okay to I see your name there. What you may be referring to, if you are working for a company where you are subcontracted out to the government, that's a different story. I'm not sure if that's what you're asking or not, but if you're working for a private company and that's where you're paid and that's your employment, but you guys happen to have a contract with the government, and that's not unusual at all, that does not qualify for the public service loan forgiveness program. But with the borrowers I've worked with, I don't think I've ever found a government job where you are working for the government, whether it's county, state, local, or federal, where it does not count for the public service loan forgiveness program. So interesting question. Maybe I read it wrong.
Great. Thanks, Paul.
And remember, Taylor, real quick, and to everybody, when you, and you'll see this on the module if you watch it, remember, if you're interested in public service loan forgiveness, you actually enroll in the program, and Taylor and to everyone, you can actually get confirmation in writing that your employer does or does not count as an eligible employer. So great question.
Great. Thanks, Paul. So if no other questions are coming in, I suppose we can just wrap up. So again, thanks for joining us today. And like Paul said, we'd greatly appreciate if you would complete the evaluation. I will follow up via email with everyone who attended to share that link again. And we'll also share the link to join our newsletter, where we will share reminders about the upcoming sessions in our Loan Repayment 101 series. We'll also share information about the upcoming events with your individual school, so hopefully they'll push that out to you as well. So thanks again, and we hope to see you next time.